Hello and welcome to yet another interesting conversation on All Talks, which is brought to you by Cafe Mutual and ICICI Prudential Alternates. As always, we have with us an accomplished veteran who's going to share his insights and valuable experience regarding alternates. We're pleased to have with us Praveen Bhale Rao, founder and managing partner at Pranitya Wealth, a premier advisory firm which is located in Pune, and it boasts of 5,000 crores of AUM in mutual funds and an additional 1,400 crores of an AUM in alternates. Welcome, Praveen. So proud to have you with us today. Uh, Audiences, I'd also like to let you know that besides his professional accomplishments, Praveen is a CA. He also holds a law degree and such a multifaceted personality that he is. He also deep dives into writing poetry and reading a lot of history during his pastime. He's also a fitness enthusiast and he likes to spend a lot of time building his strength in the gym. Welcome, Praveen. Thank you for being with
Yeah,
us.
thank you so much. Thank you for the nice introduction.
Praveen, we know that you enjoy writing and reading a lot of poetry, and we know that you've integrated this passion into your distribution business by somewhere trying to send newsletters to your clients. Please let us know how has this helped your distribution business and what's been the take of your clients on this?
Great question. Uh, it all started with my association with MNCs.
Okay.
So in 89 or 99, when I started off, I had my tie with DSP Merrill GPC and off late with Julius Baer, but today it is not there. It was there for a few years. So what I have learned from them is, you communicate to client well means a lot. Client do expect some kind of a communication coming to them. They are busy in their own life, their own businesses, and for them the wealth management or their portfolios few percent of their the total life. So that becomes our responsibility to communicate as effectively as possible. You must have seen Warren Buffett writing, Howard Marks writing to their clients, and that you really make you really distant from the rest of the competition or players in the market. So we started writing 5 years ago. Every month we, on the first or second of every month, we make it right. Idea to write on the first is show that it's a proprietary writing, not copy paste. Like secondly, we don't do any white labeling, so it's coming right from my heart. Uh, it's a simple thing like what comes to your mind today as an investor. We try to cover those topics. Typically, current topics like today, maybe tariffs, the geopolitical things. People want to understand what is happening and what could be the outcome. We need to put it in a very brief 5-page note because the attention span for clients is very low. Even we write, I just took a survey, 50-60% of the people read, rest prefer podcasts. So last 2 months, we have started writing, and plus, beside that, we have started giving a podcast also. So that's the way we try to reach, and it has really made a big difference. People wait for that note to come, and that's the testimony I can say.
That's such a unique perspective. I'm sure your clients would be really appreciating such a personal gesture coming from you.
Right.
Praveen, you've been part of the founding IIFL Wealth team and an early proponent of alternatives. How has this evolution, what's been the landscape of wealth management then, and how do you think it has developed over the years?
I think we are fortunate enough to have started little early. In '94, I was heading Kalyani Family Office, and that's the time the private mutual fund started emerging. 99, when I was running my own business, and 2010 I sold it to IFL Wealth, and that's how I came on board. From 2010, I think initially it was really a struggle. That 99 to 2010 was, there was hardly thin line between a normal broker or a wealth manager or a mutual fund distributor. Naturally so, because debt was a prominent part of anybody's portfolio. You used to get 10-14% on debt funds, so it used to dominate the mutual fund assets. A lot of them have come from the corporate side also, because they used to park their liquid money. So it was not really a retail and HNI play. It was more of a corporate dominated. debt play that at that point of time. Of course, India moved on from that 4-5% of GDP to 6% plus, and that's the time we seen really change in the flow of money into the equity funds and then alternate and all. So it was 2012 we got this real AIF guidelines, but before that people we used to do some kind of not private equity but kind of structure products and all. So those were called like alternates those days. There was of course no pre-IPO money. IPOs were very few. No performing credit, no credit risk fund, so it was not there at all. Like whatever used to it was very small play. Of course, post 2012, then slowly market has started emerging. People had started looking at alternate to the vanilla products, especially the HNIs, who has a bit of risk appetite. So you need to take any concentrated calls or take credit risk. The performing credit is a nice word because you understand the
Yeah.
cash flows and then you take the really relevant risk
Correct.
that enhances your returns on the portfolio, and that need came in later. We were InvITs, REITs, they played major role at that time, and then lending to real estate was a very novel concept. Post the era that become more regulated and more relevant. So now we have plethora of alternates available to the clients, but those days were really tough, and it was more of a vanilla investing, you can say.
Got it. You've been in this industry since 99 and you cater to some of the top business houses. How do you manage to maintain your clarity and also, have a good work-life balance?
Yeah, there's no rocket science, to be honest with you. I don't know. The sincerity and maybe honesty is a rare terms these days. I've never done anything extraordinary. I've been sincere to my reading. See, it's a responsibility or trusteeship of your client shifted to you. And when it is there, then I think we need to be client centric. Having said that, it is very easy to say, but practice. So, when I started recently on my own, we did couple of things very differently. We said it will be 100% skin in the game business for us. Of course, it means a lot of pain to us because each and every product goes from my desk to the client, be it private equity, fund, stock, or AF, anything, or PMS for that matter, has to be first invested by my family office.
Okay.
So, thankfully, God has been kind. We have decent amount of money to invest in each and every of this product. When it comes to us, we wait it. By investing, we this is a proof of pudding. Like we approved and invested myself, and then goes to the client. I doubt anybody in the industry doing to that extent, but we follow it to the T. No close-ended products in uh, listed space. We followed few rules while doing this business. I think that has been appreciated by client. Transparency is what client look at today, and expertise because many ups and downs in the market. If you go through, I think that makes you more perfect in the life. I think these are the few things we follow in life, and that I think led to the success. I don't know if I should call it a success, but that led me to this stage at least.
I'm sure you being
Yeah.
very humble. I'm sure these simple ways, but very unique approach has really led you to become so successful. Praveen, you are dealing with so many wealthy clients at all times. What are some of the common behavioral biases that these wealthy clients have, and how are you helping them overcome them?
I think very interesting and very challenging thing. Uh, See, what I've seen, like there are different types of wealth, like I call it. First is traditional wealth, the neo wealth, the startup guys who created really wealth in quick amount of time. And third could be some clients having legacy issues. They go on and sold their businesses, or there are some excess assets sitting on their balance sheet. They exited and really got money for the first time in their life. So everybody's behavior is quite different. The generational behavior is also very different. As I told you, like the recent new generation want podcasts to be sent to them,
Yes.
not the written note to be sent to them. It's all starts from that small thing. So we but the common part is the returns on the investment. That is very
Never
common.
changes.
Nobody wants anything negative like what happened in the last year. Nobody ready to believe. Especially what has happened post COVID, the risk appetite has gone up, which we have seen. People are ready to take more risk. I believe that came not from the heart, but from the easiness of money made in last 5 years. They've seen the probability of making money is high. They don't ever understand that it is because of the low base, like once in a century low base created
Right.
by COVID in 2020. So first of all, expectation management become very difficult because you come from that 5 year of very high return background. That is common across as people, rich, wealthy, educated, non-educated, and that's been the big challenge. So first challenge could be like, or first thing could be like managing the expectation of this client. So that's common behavioral we seen. Secondly, the risk appetite and the herd mentality. Like there are too much of information also created a actually a kind of a fear in the minds of people. Somebody reads or watches some channel on the TV, the guy is talking about next day movement or next day call on the stock, but we start relating our 20-year portfolio and then start acting like we are a trader in the market. So I don't mind skipping any sector because if I do that, I know I'll not be able to do justice or I'll not be able to handle so many clients uh, running my F&O strategy. So that's completely no at our end, and lot of people I don't know they are burnt, but definitely they have slowly understood the risk. It is not so easy. There's no free lunch in this. So people have started now looking at really long term. The long term definition used to be 2 and 3 years in our country.
Correct.
So that has fortunately changed. People come to me and say, "Ravi, this is long term money. I don't want it for next 10 years." That's a sweet change I see. But the the information flow has to be read properly by clients. Otherwise, many times you miss opportunities. In last 1 year, we had so many incidences where market had gone up and down, surely because of the external situations, not nothing to do with fundamentals in India. And people try to react to all these situations and have really lost money. I've seen people exiting at wrong times. So that understanding about market has to be there, or you have to have trust in your wealth manager or the consultant you have appointed. But yeah, there is a good change happening, and whatever money has come, look at the SIP flows and the exits from the local money. It's been hardly there. So that shows industries or the clients are really maturing at this stage. It's a
Interesting.
good change.
Good. And Praveen, what are the kind of opportunities that you see in dealing with the wealthy for the coming years?
I think first generational change was the biggest challenge. Secondly, you can't now depend on India. Though 2047 India looks good, we talk about the golden period and Surna Kal,
Yes.
and all that is fine. But look at what happened in last 2 3 years. The other markets, India was the lowest performing market last year. So we need to open our eyes and start open your mind even to invest in other markets. That's first. Second is we are completely globalized. Just announcement of tariff has created a lot of havoc across the world. So that integration, when suddenly you start looking inwards, will mean a lot of changes to be done in your own portfolio because supply logistic changes.
Yeah.
Suddenly tomorrow you are buying oil from Russia to next day you will be buying from America. It's not so easy for any industrialist. So that then again you have to do changes and adjustment to your client's portfolio. That looks a bit challenging. So geopolitical changes is a major thing which you don't have control of. Third thing which I've seen is like a rise of alternates. So you can't just stick to vanilla mutual funds and equity funds and all. We should open your eyes and look at positively for alternatives. Yes, new category like arbitrage income plus or performing credit. There are so many AIFs which are launched by mutual fund companies, well regulated. So that offers some kind of a specialization in terms of costing. Also, they offer a lot of advantage. Today, you can't do any cost differential in mutual fund, but in AIF, or alternates, you can negotiate your cost and stay your cost in control. Uh, all that is possible. Even now, the SIF also allows you to short at times, because the long only market you are fine, but volatile market you need to hedge your portfolio. You can't do that easily if you don't have a fund account. But the emerge of SIF can offer you kind of offering some kind of a protection when markets are moving down directionally. You can't expect linear bull run in any market.
Right.
So you need to have the alternates in your pocket to offer some kind of a real portfolio diversification, or we call it asset allocation, which is become a little, people have become complacent looking at the equity returns in last 5 years. I think time has come to look at the alternates very, very actively.
You've made a very valid point. We also believe that distribution really needs to get evolved and start offering a lot of other products. On that point, Praveen, how do you think the MFDs who are not yet looking at alternatives, how can they integrate alternates into their business strategies?
I think people don't read much. Sorry to say this, but it's not question of your AUM and your delivery, or AUM and your output, or the, it is must when you are in the industry. We are, all of us are fortunate to be in the mutual fund distribution industry today, because India is on the cusp of that high growth phase, growing at 6.5% plus, and offer next 20-25 years. I feel it's a good bull run there. But when it comes to delivering returns to client, I think people talk about asset allocation, but I know for last 2 years we've been talking about debt funds, and nobody even is bothered at us. Really, it has gone for a toss. So people are not looking at it. Thanks, of course, lot goes to the taxation blow we received, but some kind of a blended strategies, not 100%. You can't run a 100% equity portfolio, so blended strategies are a must. Uh, so you have to really look at client and then strategize how you can blend. Fortunately, we have so many products on hand.
Yes.
SIF is there, AIF is there, mutual funds are there. So right amount of mix and alternates along with the vanilla products can make your portfolio really great. But the people don't spend enough time in reading even fact sheets that matter, and that's how the and going by past return doesn't mean anything, because the market conditions keep changing every day virtually, and that's how we feel one need to really improve. Of course, SEBI is making, sorry, MF is making all the efforts to make distributor give exams, and that way they will prepare most of the even employees within the company to have the right amount of understanding about various products. Within our company, we do a lot of efforts. We do a lot of webinars. We call a lot of experts to talk and see that my each and every of my employees capable of talking to clients on any subject which is relevant for him. Yeah.
Interesting. Praveen, you run Pranitya is one of the leading and the largest wealth management firms. Uh, Given that we definitely cannot close this interview without getting your feedback and your advice for the aspiring wealth managers who are wanting to begin their next.
I think staying relevant is very important in this industry. So the industry is so big, the pie is so big for everyone to eat. So I'll definitely advise a lot of people to look at this. But today, understand the costs are going up and the commissions or incomes are going down. So you need to operate within the limitations. So not to look at competition is first rule I followed. I never know what my AUM is also. So you guys come and tell me at times. But I never look at my competition. I'll stay focused on my clients. You have to find a niche. When I was working with a very large organization, which there we used to chase each and every deal happening in this country, maybe of any size and shape. But today I never go there, because I know I don't have a brand, but I have my own limitations which one should understand and carve a niche within that to approach clients. Just go and don't bang your head on every wall. So we approach clients up to 500 crores. That's my strategy. If I get 1,000 crores, I'll be very happy. But I never try that. It will be by default, not by design. So Taro understand. Some people will be very good at approaching professionals. This market is so big. Tier two, tier three cities are they are all open. We get so many clients from these cities, and the first impression is that they are not served well. They are not even not talked about many products there. So I think the platter is too big, and one need to really approach well. And for that, I think you really have to study a lot. You have to have something more to offer than the competition. Like we do a lot of webinars, educative sessions for client continuously till client says no. Like it's the other way around. So we pamper them with a lot of red. So once you educate client, I believe your job becomes really easy. Plus the research, the understanding about market currents, and we need to be honest, not driven by products but by service to clients. I think that simple things will make you float even without with the competition. Competition is going to be intense. Consolidation is happening. You are hearing news every day. Something is being acquired. That will be a that will keep on happening. And technology, AI will kill. The general consensus is 30% of the job will just go like that. So you need to be sacrosanct of technology coming into your space, and we need to be prepared for that. I know there are very limited things one can do. All goes with the business you do. We do only HN, as you know. We don't have any retail business. But when you are doing a retail business, I think you're more involved technology in your business. See how you. That's what first word I say. You stay relevant in the market, and I think this is the biggest of the opportunity one can have. Only you see you keep your head out above the water by doing all right things for clients. If client accepts you, then it's very easy. Today we are no brand, but we created brand out of no brand virtually, and we stayed relevant for last 25, 30 years with a lot of competition around us. I think this is a simple lesson one can take from this. I am not a great person who can offer something big advice, but I think simple things can really help in long term, and that's how it is missing today in the markets. Thank
Thank you,
you.
Praveen. Your experience and your entire expertise has been very beneficial, and I really had a great time chatting with you. In fact, this has been like a masterclass for me because I got to know about so many behavioral biases that wealthy clients have, and I'm sure our listeners are going to really enjoy this conversation that we've had right now. And it's also very inspiring to be able to meet somebody and hold a conversation, for somebody who's not only managed and maneuvered around the complexities of wealth management, but also finds the time for his own passions, and you're having fun around it. So it has been a great inspiring experience for me. I hope, listeners, that you've enjoyed this conversation, and I would nudge you and urge you to subscribe to All Talks so that you don't miss out on a single conversation that will help you begin your next. Thank you so much. And until then, keep learning, keep growing, and keep evolving. Thank you.